Good evening and a very warm welcome to First Issues. The Botswana banking sector is operating in an environment that is very different from that of a few years ago. For example, interest rates continue to fall in a low inflation environment. The Ministry of Finance recently reduced its growth forecast for the country's 2015 real GDP to 2.6% from the original 4.9%. And rather than a fiscal surplus for 2015, the ministry has projected a deficit of 1% of GDP as a result of the recent slump in diamond prices and demand. Unpleasant news for all business. There are now many more banking institutions as new entrants onto the market increase competition for market share. Businesses and households continue to be under pressure, affecting their ability to repay their loans and making banks tighten their credit requirements. It is in this new environment that even market leader First National Bank, despite an increase in its non-interest income, advances, its customer base and deposits, announced an 18% decline in profit before tax for the year ending 30th of June 2015 at the financial results announcement held yesterday morning at the Gaborone Convention Center. And it was at this event that we asked the incoming Chief Executive Officer, Stephen Bogatsu, as well as the outgoing Chief Financial Officer, Boitumelo Mogopa, as to how FNB Botswana navigated this challenging time. Beginning by asking the CEO about the global and local trends that have resulted in this new environment.
Well, the global trends that have impacted us include what is happening in Greece, what is happening in China. As you would appreciate, those are markets for our exports. The European Union, which Greece is part of, is for our beef exports. You know that China, Japan, and the US, those are markets for our diamonds and other commodities. So any adverse developments in any of those markets will impact our exports directly. From a local perspective, we have had a number of things. You know that the Botswana environment, the Botswana economic environment is undergoing some challenges. The GDP growth has been reduced from about 4.9% to about 2.6%. Obviously, that impacts the banking industry directly, as there are fewer lending opportunities than there were in the past. We have also had some developments around liquidity, where we had challenges with liquidity, and we just want to emphasize that it's not a crisis, it's just some challenges that we have had with liquidity, and we have put measures in place to counter those risks that we have seen in the last couple of months. The impact obviously for the bank is that our interest expenditure has gone up. It has increased significantly because we are having to pay a lot more for those deposits. So those, in summary, those are some of the challenges that we have had. Obviously, the challenges related to the economic environment have impacted our lending opportunities. They have also impacted our impairments. If you look at our income statement, the one that we was presenting, you will appreciate that the challenges that we had were around interest expenditure, and they were around impairments as well, because of the environmental factors that I have just mentioned.
What approach did FNB decide to take in this challenging environment?
We have always indicated that we know that the business environment goes through ups and downs, and in order to ensure that we are cushioned or insulated against those challenges, we diversify our income streams. So on analyzing our results, you will find that the interest income has actually declined by about 6%, but our non-interest revenue has increased by about 9% as a result of our customers using the various products that we have, the volumes increasing, as well as additional 20,000 customers that we acquired during the financial year. So the diversification efforts that we have previously communicated with our stakeholders have helped us navigate some of the challenges that we are seeing.
Which diversification efforts are you speaking about in particular?
Diversification efforts around our income streams. So as a bank, we are positioning ourselves in such a way that we are not dependent on any one income stream, but on a number of income streams. And that is what has come in handy during these difficult times.
Stephen Bogatsu became the CEO of FNB Botswana very recently. Having taken the reins under quite a difficult environment, what approach did he choose and what goals did he set for himself to take on this challenge?
It has been a difficult couple of months, but the approach has been to work closely with the team to look at the opportunities that are available in the market and not to focus on the challenges, but rather to focus on the opportunities, and that's what we have done. That's what we have been doing. We have just been focusing on the opportunities out there and ensuring that the bank, through these challenges, remains solid.
What would it take to return to the profit margins FNB used to enjoy in years past?
Again, I must make it very clear that the banking industry is still actually very profitable. The challenges have set the profits slightly backwards, but not into loss-making mode. So the banking sector is still relatively solid, and we will navigate the challenges that we are currently seeing, and we will overcome them, and the banking sector will remain profitable into the foreseeable future.
Welcome back to First Issues as we look into the approach taken by First National Bank Botswana to navigate a new and challenging environment for the banking sector. During your presentation, you listed some structural reforms that have been implemented to counter the liquidity challenges. Could you expand on these, and have they been effective at all?
We have put in place a number of initiatives to make sure that we don't rely on any one source, but on a number of sources. We have put in products across segments, and we've been advertising the products that we have to address the demands of our customers, which will help with our liquidity situation. We've got products that we are offering around the consumer. We've got products that we are offering around the business, so that we can diversify away from the offerings that we have in the R&B space. That is an attempt by us to move away from dependency on any one source of funding.
Those are internal measures the bank took to counter the liquidity challenge, but I'm speaking of the broader external ones by the central bank.
In the last couple of months, the central bank has actually reduced the reserving requirement from 10% to about 5%. And that has eased the pressure, injecting about 2.3 billion into the industry.
You spoke of your diversification efforts paying off, but this in light of a minus 18% decline in profits after tax. Help us understand this.
If you look at the results of the industry as a whole, you will realize that the 18% decline by FNB is relatively smaller compared to other players in the industry. It's also very visible from the increase in our market share, our profitability market share, which has increased from about 39% to 54% as at May. That just shows that our diversification programs have paid dividends.
Again, I'll backtrack a little bit and ask, can we expect the profits that the bank and other members in the industry used to enjoy?
A new normal has set in the entire banking space. The banking space or the banking industry remains profitable, but you are unlikely to see the profitabilities of yesteryear in the foreseeable future.
It appears that this bank always has some new electronic offering in what they call their Bricks to Clicks campaign. What new solutions can our viewers look forward to in the near future?
There are a number of things that we are launching. The ADTs that we launched, ADTs are our deposit-taking ATMs, have performed extremely well. They've been well received by the market in the last couple of months. So we'll continue launching more of those devices going into the future. We also have smart devices that will be availing to the market in the next couple of weeks. which customers can purchase using FNB. But these smart devices will be loaded with FNB apps to enable customers to access their banking products and services directly without going through other channels. You wanted to know earlier what else we have in the offing. We indicated during the presentation that not only will we be rolling out these smart devices, but from a channel perspective, we will be increasing the number of branches. We will make those announcements as time goes on. And we are also refreshing some of the branches. We have a program up to 2020 where we are refreshing the estate. That is, we are giving our branches a new look and feel. And this is a project that will be starting now. And it's a project that will cover all our branches. And we know that we'll complete this project by 2020.
Welcome back to First Issues as we look into the approach taken by First National Bank Botswana to navigate a new and challenging environment for the banking sector. Having spoken to the CEO as to the various factors at play in the industry currently, in this portion of the program, we talk to the Chief Financial Officer at the bank, Boitumelo Mogopa, about the bank's performance. In her presentation, she mentioned an increased customer base and deposits on one hand, and an 18% decline in profits after tax on the other.
You would remember that we spoke about the tightened liquidity in the market that we experienced towards the end of 2014 calendar year. So in fact from September, October, that's where we started feeling this liquidity squeeze, where suddenly deposits suddenly became very expensive to attract and also to maintain. As a result of that, we then needed to expand our sources of funding. So we did get deposits. It's just that at that time we now had to get expensive deposit, for lack of a better word, what we call professional funding, just to make sure that we are liquid. So that on its own increased our cost of funds. So when that happens, it means that the profitability will not be as high as you would have if you had diversified deposit base from a transactional perspective at least. So that's the first thing. So deposits, yes, we got them, but we got them at a price. Cost of fund was quite high, so it didn't translate as you would necessarily want it to. We then drove volumes by way of customer numbers. You'd have seen that we moved from about 410,000 customers to about 430 customers. So again, where the growth was coming from was really out of your student accounts. As you know, we work with the DTF who sponsors students. So what we then do as a bank, we offer banking services for these students. Students get their allowances, and then they are very, very good with the clicks, by the way. So cell phone banking is a big one, and and online banking here and then, e-wallet. It's quite popular with students. But that's about all you can do. So you can't lend to them such that, you can do so many things with them to an extent where you can then grow revenue from that perspective. So that is really the context. We say, yes, we grew customer numbers, but it is where we grew it that limited our opportunities to make the revenue and cross-sell to that particular client base. Because as a student, you're not going to necessarily get a loan tomorrow. You're not necessarily going to get a credit card. You're not necessarily going to get save a lot more or whatever. Unlike if you are a high-end customer who can do a lot more with the bank. We then grew transactional volumes, because remember we needed to say, so what is that we can do, that we can, what can we do? What levers do we have to pull such that we can come out of this environment? So we grew transactional volumes, and as you can imagine, I shared with you, we grew our online banking transactions, we grew our ATM transactions, our cell phone banking transactions. So now by their nature, the clicks environments, their fees are quite subsidized, for lack of a better word. Remember, we are encouraging it. So we say to customers, don't come to the branches because it's too expensive for you. Go to the online banking or go to this platform because they are cheaper for the customer. So as a result of that, because now they're cheaper, they will not result in the the high revenue that you necessarily would get if they were using the branches. But as a bank, we are okay with the strategy because we think that is a sustainable strategy that's going to give customers convenience. That's also going to eventually help the bank be much more efficient around, we don't necessarily have to be, spending too much in infrastructure when we can migrate customers to efficient channels.
That said, what are the major achievements that the bank is really proud of itself during this challenging time as we come to the end of year results?
I think that we managed the liquidity very well. I mean, it was a very tough environment. I mean, other markets will tell you this was nothing, but I guess it was a first in Botswana. So we learned quite a lot. At the same time, as Steve mentioned earlier, Group also assisted by saying, there are, alternative sources of funding if there is no liquidity in the country. So we learned that quite well. So we think that we managed the liquidity very well. And the second thing is we then said, at the end of the day, as a bank, we've got a customer base. I think, as you know, the FNB holds the highest market share in terms of customer base, about 130,000 customers. So once again, it's the realization of saying, actually, sell more to your own clients. So we saw ourselves cross-selling a lot more. So as an example, where a customer opens an account, they don't walk away with just one account. They also are able to open a savings account that they can also have a stop order into that savings account on an ongoing basis. That customer will be signed onto the electronic channels. They will have cell phone banking, they'll have online banking and the FNB app. So there's a lot of choice that they can do. They are also educated around how to use these, platforms because we're not all techno-savvy, I guess. So we've on a journey to say, over and above, we shouldn't just sell them to customers. We should actually demonstrate to them how they work. And we've got very positive feedback from customers, saying that actually the days of me driving long distance to go and buy power at shop is an example are over because I can do it in the comfort of my home on cell phone banking. So we then, as a result of that, we focus on our customer base quite a lot. We also launched the ADT. I think you heard Steve speak a lot about the ADT. We think this is our biggest positive. I mean, you should see the demand in terms of that particular platform. Customers now know that if I want to deposit cash, I don't have to go to a branch. I can actually do it at 9 p.m. and I can see the deposit immediately after I've deposited it into my bank account. So that has worked wonders for the bank and we are quite proud of it. And as we already communicated, we've got about 20 right now and by the end of the next financial we have about 50. The other one is the one that Steve spoke about, the star 174 hash. This is really another platform that customers can use to pay bills. So it's another channel really when you think about it. And the beauty about it is that it's now also open to non-FNB customers. So you hear non-FNB customers saying, actually, FNB offered me a platform to pay for DSTV without me having to bank with FNB. So we think that, that outreach, at some point it will actually convince the client to actually come and bank with us. But it's opened up these channels for a lot of our customers and the ones that don't bank with us. So we think those were really the achievements that we've had this financial year.
How big an impact did impairments have on the bottom line?
It was quite significant. I mean, it was 64% increase on a year-on-year basis. I think if you look at where we come from as a bank, because we've been, the most part of our book is largely secured. If you look at our property book, our West Bank book, and some of our term loan books, this is a new normal kind of coming through here. And it is as a result of what we are seeing in the property market, where suddenly the valuations are lower than anticipated. We are not able to sell these houses at the open market value rates. So that alone will cause impairments into the book. So we are seeing this suddenly in the market, and it's impacting your high-end customers. Property values of about above 1 million pula. So those are the ones that are really impacted. What we're also seeing is because government is not spending that much from an economic activity perspective. The small businesses are also struggling. So as they struggle, and they've got facilities with us, it also, is taking up this particular line. And I think it's even more of a challenge in business because we are yet to develop a scorecard, an automated scorecard for business, such that we remove the judgmental credit assessment for business. But it's something that is coming soon. It's just that now we now need to deal with what has happened in the past. But from a consumer perspective, other than the property book, we're seeing a slowdown, at least in terms of what we're seeing in the bank, because we've long introduced a scorecard for consumers. So this scorecard is automated. It's also risk-based. So what it does is it just, when you open the account, when you want a loan, it just scores you as Namezo, and it says, what kind of a client are you? Do you default? Do you bounce your checks? Do you overdraw your account and what have you? And then it will give you a loan based on that assessment of that customer, and it will kick in an interest rate based on that particular risk profile, as you would put it. So we've seen that improving the consumer, particularly on the personal loan side of things, because the scorecard is doing quite a good job.
The banking industry has seen a new normal setting in. We have had challenges, some serious challenges, and because we believe that the future is going to improve, that what we are seeing is passing.
Both the CEO earlier in the program and the CFO just now have alluded to what they call a new normal within the banking industry. But what new realities are they referring to when they speak of this new normal?
A new normal really means that things have changed. If you just consider the banking industry 3-4 years ago, we were not talking about the things that we're talking about right now. So right now we're talking tight liquidity. 4 years ago it was not an issue. In fact, the central bank wanted to mop it up. There was excess liquidity in the market. We were not talking about moratorium on bank charges at all. If you are going to grow your non-interest revenue, it has to be volumes only, or it has to be a new product where you now need to go to the central bank and request for new pricing. We spoke about low interest rate environment. Now, just by its nature, when interest rates fall, that means the margins that you've been enjoying on your advances book are going to reduce. So from that perspective, both revenue lines are under pressure, from a net interest income perspective and from an NIR perspective. So this has just caused a new norm in the industry. And it's not, as I said, not just FNB who's contending with this thing. It's actually, the whole industry having to say, so where is the growth going to come from if the only two revenue lines are under so much pressure? So that's why we call it the new norm.